All right, great. Okay, so good morning, everyone on the call, and welcome to the Buying Australian Property While Overseas webinar. Today's session will be presented by myself from Odin Mortgage and Rich Harvey on the call today as well from propertybuyer.com.au. We'll be going over some of the tips and tactics for expats, as well as a general market update of the Australian property sector. So with that, I'll get started. Today's agenda will be quickly doing some speaker introductions, so you know who's speaking on the call today. And then we'll be going over some tips and tactics for financing the property from a mortgage perspective. And then I'll pass over onto Rich, who'll be doing a market update and giving you some gems that he's picked up over the 20 years he's been doing this. And then we'll wrap up with a Q&A. All right, so your speakers today are myself. So I'm an accredited Australian mortgage broker, and I'm presenting from Odin Mortgage. We mainly focus on overseas residents. So expats are our bread and butter. My focus today will be talking about how to get a mortgage, what are the differences for expats, how to alleviate headaches when you're buying a property, and also how to cash out from your existing properties if they're appreciated in value over the past couple of years. On the right, you have Rich Harvey, CEO and buyer's agents from propertybuyer.com.au, which is actually one of Australia's most awarded buyer's agencies. So Rich has 20 years of experience in the property industry. He previously served as the president of the Real Estate Buyers Agent Association for 4 years, and he was also chairman of the Buyers Agent chapter of the Real Estate Institute of New South Wales for over 9 years. So we're very fortunate to have him take time out of his schedule today and be with us here to give us some gems.
Thanks, Martin. I'll just jump in there as well, guys. If you've got any questions, if you could just put them in the chat box, not the Q&A, but just put them in the actual chat box. It'd be really helpful. And then that just keeps them all in the one forum. And we'd love to answer all of your questions. We've left heaps of time at the end for questions. So please put them in there as we go through.
Yeah, great. So I'll be keeping my part relatively short today so you guys can hear a bit more from Rich. So let's get started. So why should you use an expat mortgage broker? Well, a lot of the times people do ask me this question. So can I get financing myself? Can I do everything myself? I speak to the bank myself. Why do I need a mortgage broker? Well, their answer is you could actually do it yourself, right? So everybody in this chat today or in this webinar can actually go and get a mortgage themselves. But what that means is you have to research 30 different banks in Australia yourself, understand how each of the banks work and all their policies. You have to manage the agents and the solicitors yourself. So there's all these parties that you need to deal with: the selling agent, the buying agent, the bank's lawyers, your own solicitors. Manage all these yourself. Fill in the application form yourself. So these application forms from different banks can range from 5 pages to 30 pages, depending on how digitalized this bank is. You have to collect all the documentation yourself. So some banks require up to 20 different supporting documents, and you have to comb through the list and apply for all these different banks and submit all these different types of documentation. So you could do all this yourself, go back and forth with all the banks yourself. So usually there's a bit of negotiation and clarification from the banks. And this can usually go back and forth 3 to 4 times over the course of a few weeks. Then you would witness everything and execute the contracts alone. Now, after all of that, you're most likely going to get rejected, right? And you're going to be pulling your hair out yourself as well, because it's just extremely difficult for expats to get lending at the moment. Now, the alternative is to use an expat mortgage broker. So at Odin Mortgage, we'll perform the preliminary assessment for you before submitting, and we'll guide you through the entire process. We'll also manage all the parties involved, and we do this all for free. So as some of you may know, the mortgage brokering industry is actually compensated by the banks. So there's actually nothing there will be no cost to you from our end. So for those of you who do like to pull your own hair out, I'll be giving you 3 tips today. So tip number 1, research which banks will apply Australian tax rates versus which banks will give you local tax rates. So for example, if you go to a big 4 bank like ANZ, Commonwealth Bank, NAB or Westpac, they will actually be applying Australian tax rates on your Singaporean dollar income or your Hong Kong dollar income. And as you know, in Australia, tax rates can go up to 45%. So the effective tax rate that you could be paying that you could be subject to at a Big Four bank will be in excess of 30 to 40%. Whereas if you went to an expat-friendly bank and they applied local tax rates of 15 to 20%, you can get a lot more borrowing. So you're going to make sure you go to the right bank. Number two, know which banks will lend you 80% and which banks will only lend 70% for expats. So for example, some of the banks, they will lend you 80%, but only under certain conditions. And then on the other hand, some banks will only lend 70% for expats, whereas they would have lent 80% to people back in Australia. So if funding and the deposit is a concern for you, you got to make sure you go to the right bank and make sure all these things are lined up. And then tip number three is policies need to be relevant to your situation. So what I mean by that is some banks will only lend towards multinational companies. So if you're a school teacher at an international school in Singapore and Hong Kong, some banks won't touch your application and they won't put it through. Now, let's say you're a lawyer or you're a banker and you have very high bonuses and the bonus form's a big part of your application. You also need to go to a bank that will accept bonuses. So some banks will only take the lower of the last 2 years, some bank will take the average, and some banks will take no bonus at all. So if we need to rely on your bonus, we also need to know which bank to go to. Same with cashing out equity. Some banks will allow you to take out equity, no questions asked. Some banks will require you to have a contract before they'll give you equity. And then with refinancing, again, it depends on the bank. So it depends on the policy. So come speak to us. But for example, refinancing, if you were to try to refinance your loan at St. George, they would just turn you away because St. George doesn't do refinances at the moment. So again, these policies are always changing and it's best to speak to someone who's really plugged into the market and knows exactly what the policies are. So we get updates every day on how policies have changed. Now you can, again, research all these policies yourself, but it probably isn't the best use of your time. So why were those things important? So let's go through an example, right? Let's say you're a Singaporean and you're earning $10,000 per month. After the foreign income discount at a regular bank, you would have $8,000 left over to service your loan. And then they apply Australian effective tax rates. So let's say the effective tax rate on that income is about 30%. You would then have 5.6K Sing dollars to service your loan. Then let's say you're renting as most expats do. 3K is actually on the low end, I think. That would equate to about 2.6K per month to service your loan. And then there's living expenses. The bank will assume living expenses for you. Let's say they're 2K. So after all of that, even though you're earning $10,000 a month Singaporean dollars, at the end of the bank's assessment, you will only have $600 left to service your loan, and the borrowing power would probably only be around 200K. So that's not very much at all, especially in today's environment. Now, what does it look like if we went to an expat-friendly bank? Well, some banks actually have no foreign income discount. So your 10K remains as 10K, no shading of discounting of your income. They will apply Hong Kong or Singaporean tax rates, so local effective tax rates, and your income will be around $8,000 per month, assuming 20% Singaporean tax rates. Then, same as before, rent expense of about $3,000 per month. It'll be 5K per month left over. And then living expenses of about $2,000 per month. So you have about $3,000 left over to service your loan. So a 5 times difference in the free cash flow after all these assessments will result in about 3 times the difference in borrowing. So that's why policies at different banks is very important. So it's not always just about rates. So maybe the Big Four at the moment have very sharp rates, but if you went to a Big Four, you wouldn't even be able to borrow, let's say, the 200K needed. So yeah, expat-friendly banks are definitely the ones to go to for all of us here in Asia, and I'm not living in Australia. So the next section I'll go through is how to avoid settlement headaches. So the answer to this question is very simple: get a pre-approval. So pre-approvals give buyers negotiating power. They confirm how much you can borrow. So a lot of the times our clients, they sign a contract and then they try to get borrowing, but then they realize that and the bank was never going to lend them that much money in the first place because of all these policies that I mentioned before. It also mitigates against the loss of deposit and a void of contract. So let's say you signed a contract and you didn't have financing in place. You sign it, you pay the 10% deposit, and you continue to believe that you can get financing, but then it actually doesn't work out for you. You would actually lose your 10% deposit, because when you sign a contract, it's actually unconditional. There may be a subject to finance clause, but if they don't offer that, especially in New South Wales where that's not offered, then you could potentially lose your deposit. And also at auctions. As mentioned before, it gives you negotiating power relative to other buyers. So a lot of the times our clients will go to an auction or go to a bid, and then they'll be up against other buyers. Now, if you have a pre-approval ready, sometimes you can get negotiating power and be able to negotiate a discount on the offer price. So pre-approvals are valid for about 3 to 6 months, so you can focus on property hunting. You don't want to be in a situation where you're looking at properties and then you're juggling the financing, and it just all becomes quite tedious to do everything at the same time. So you want to get your financing sorted. It's valid for 3 to 6 months. Then you engage someone like Rich and his team to help you look for a property, so you can focus on getting something that's relevant for your situation, in pockets of undervalued areas, something that you actually want to hold for the longer term. And then finally, again, all of this costs nothing, especially when you're doing the pre-approval, because banks will only charge you fees upon settlement. So you can go through this whole process with us for free and we charge you nothing. And then none of these fees are actually payable until you actually find a property and settle on the purchase. So what does the pre-approval timeline look like, and what are the steps involved? So step 1 would be to do an online assessment from Odin Mortgage. This takes about 5 minutes. And then after you provide us with your information, we will send you an email so you can review your lender, review your options, and confirm your loan structure. Then you'll be uploading the supporting documents at your own pace for us to vet what you've told us and make sure the story matches what we're going to be sending to the bank. Then we'll submit the application for the lender to review. That takes about 2 to 4 weeks, depending on how quickly we can return outstanding items to the bank. And then your loan is generally pre-approved from that point onwards for about 3 to 6 months. And that's when you would engage someone like Rich to help you look for a property and begin your property search. Then after you find a property, you would sign the contract of sale and the loan agreements. And then finally, the settlement, usually around 1 to 2 months after you sign the contract, will be handled by your advisors, so your broker, your agent, and your solicitors. So here's a case study of what not to do. So we had a previous client in March of this year. They found a dream home and made an offer for the property, right? And then they were assured by their selling agent. So please remember this is selling agent and not buying agent. The difference is a selling agent has the seller in mind, whereas a buying agent has the buyer in mind. So the selling agent and the local broker, so not an expat broker, told them that the financing was easy and to make a bid first without finance so that they don't lose their dream home. But what ended up happening was they could not secure financing at a Big 4 major bank because the local broker just told them to go to, let's say, Commonwealth Bank, and they were never going to pass the stress test there. So at the end of all of this, what happened was they had to renege on the contract. Fortunately, they didn't lose their deposit, but they did lose their dream home to another buyer who actually put in an offer that was lower than what they were willing to do. So that's what not to do. Now, what is the perfect purchase? So let's give an example of that. So let's assume that we start a pre-approval today. We would be able to secure a pre-approval for you in the month of October with sharp rates and sufficient lending after we performed the assessment for you. Then in the month of November and December, you would engage a buyer's agent like Propertybuyer and Rich's team, and you would begin your property search. You would be able to leverage on all the advisors' expertise and use the pre-approval to potentially negotiate even a discount to the offer price. then in January of 2022, which would be next year, your settlement would be handled by all of your advisors. So the whole team of advisors who have had many years of experience doing this will guide you through the process. So how to cash out from existing properties to use as down payment. So this will be the last section of my talk. And whether that be cashing out for another investment property or cashing out for the dream home that you guys want to move back to when you move back to Australia. So how do we do that? So what are the pros? Well, first I'll talk about the pros and cons of cashing out equity, right? So cashing out unlocks capital gains that have accrued on existing properties. So if you bought a property 5 or 10 years ago and it's gone up in value, rather than sell it and subject yourself to capital gains tax, you can actually unlock these capital gains tax through like equity cash out. So what that means is actually you're just taking out another loan against the property. So why would you do this? So this minimizes the cash contribution that you would need for this purchase. So let's say you do have 100 and 200K saved away, ready to make a property purchase, and you had that ready to pay for the down payment, but actually you don't technically need to use those savings if you can unlock the capital gains from existing properties. And this is actually a very common investment property strategy, right? So that 100 to 200K that you've saved up, you can use that to buy other investments, whether it be shares or bonds or cryptos. Cash from your savings at the moment can be saved for other purchases or other investments. So why you would cash out, another reason for that is you could potentially restructure your current unfavorable mortgage to lower rates. So let's say you bought a property 5 years ago and you got a loan at Westpac or NAB. These banks will never actually tell you that you could be on a better rate. So at the moment, market interest rates are probably less than 2.5% for 2-year fixed. If you're paying anything above 2.5%, then you're probably getting ripped off by the banks. Like they're not going to email you and tell you, hey, you can actually be on a lower rate. And if you use a previous broker in the past, if they're not doing their job and telling you that you could be on a lower rate, come speak to us, because rates at the moment are on less than 2.5%. And a lot of our clients that come to us, new clients, they're paying interest rates of 3 or 4%. So it's really not the right rate for you guys at the moment. Now, lastly is cashback incentives. So a lot of the times people don't want to refinance because there's costs associated with refinancing. But the thing is, a lot of these banks will offer you a $2,000 or $3,000 cashback to cover the switching costs, which is actually more than the cost of switching. So you actually come out ahead. So the costs of switching are usually covered by the cashback incentives if the bank offers it. Now, it would be remiss of me not to talk about the cons of cashing out, right? So if you are cashing out, what that ultimately means is you're getting more lending, right? So with more lending means you will have to pay high interest costs. There could potentially be larger repayments, and you would potentially be over leveraged. So depending on your financial circumstance, you really need to crunch the numbers or have us crunch the numbers for you and make sure you can manage these repayments if you were to take out more lending. And at the end of the day, usually you would have to increase the tenor of the existing loans, which means you would be repaying the loans over a longer period. Now, all these are considerations for you to think about, but if you give us a call, we can definitely work through these with you. So let's go through another case study of what cashing out looks like. So let's say you bought a property in 2015 for about 600K, and you managed to get 480K of lending, which is about 80%. So it's very easy to get 80% lending, let's say 5 to 10 years ago, but now it's actually relatively harder, but can still be done. Now, let's fast forward 6 years, assume that your property has actually gone up in value. It's gone up to 800K and the mortgage left on it is about 400K. So it's about 50% LVR left. Now, what we would do is we would help you cash out the property of about 240K. So an extra 240K of lending, meaning the LVR has now gone back up to 80%. So what do you do with this 240K that you've cashed out? Well, assuming you want to buy a $1 million property, the purchase price is $1 million. We will try to get you 80% lending. You will have stamp duty costs about 50K. So the total you need to pay will be about $250,000. But with the original cash out that we did for you, the funds required from you would only be about 10,000 Australian dollars. So that's how you would use a cash out to expand your investment property portfolio or buy that dream home for you to move back in when you go back to Australia in the next few years. So wrapping up my section on mortgages, I'll give you guys another 3 tips and takeaways, and then I'll pass it over on to Rich. So number 1, use an expat mortgage broker if you're based overseas. Now, you may have a local broker and they'll convince you that they can do the mortgage for you. But the reality is local brokers will probably do 1 expat deal, maybe 2 expat deals every year. And they have definitely not seen all the different policies of the banks. Whereas Odin Mortgage, we focus on only non-residents. That means we do about 10 to 20 of these expat applications every month, all right? So 1 or 2 for a local broker every year. We do 10 to 20 every month. Number 2, avoid settlement headaches and maximize your negotiating power with a pre-approval. And then tip number 3 is review your existing mortgage and properties for cost savings and cash out potential to make sure the banks are not ripping you guys off at the moment. So with that, I'll pass on to Rich, who'll be talking about buying the property and tips and gems from his 20 years of experience.
Perfect. Thanks so much, Martin. And we've got a few, keep those questions coming, guys. I'll just share my screen now and pop it up there. So that's screen number 2. It's that one there. And share. We're good to go. Excellent. So thank you very much, Martin. That was really informative. Love your case studies. And yeah, we'll cover some of that material as well as we go through. So what I want to do briefly with you today, guys, Martin's already given a really nice quick overview of myself, but just to reiterate, my company's been going for over 20 years. We act exclusively as buyers agents. We don't sell property. We purely act as advisors and buyers advocates to help you identify the ideal property for your situation. We've bought over 3,000 properties, won over 36 awards for excellence, and we're fully qualified with a number of accreditations and organisations, and we're also fully qualified property investment advisors. So today I just want to give you an overview on the market. How long will this boom last? Talk about what's going to happen once we finally get out of this never-ending lockdown. So we've got a roadmap out at long last. Talk about some buying tips and also give you a bunch of case studies, and then we'll go to Q&A. So how long will this boom last? That's the word on everybody's lips. So here's 16 reasons that this boom is going to continue. I'll give you the takeaway here, and I think we've got at least another 12 to 18 months left to run on this current boom. Even if APRA, touch the brakes on lending requirements, I believe we've got still a number of these factors will continue. We've had a really strong, resilient economy. Obviously, the government's pumped in a lot of money through quantitative easing and bond selling. So we've got a lot of money, a lot of liquidity in the economy. Unemployment's actually went up. It didn't go nearly to the 10 or 11% that they were predicting in 2020. We've in fact almost down, I think, close to the 5% level again, and that the forecasts are very good for unemployment. We've seen a lot of trends come out of COVID, and that is people want bigger and better properties. They want a home office. They want more space. The kids are driving them crazy. Their partner's driving them crazy, right? And they want lifestyle, and they want it now. So we're seeing a lot of what we call exodus to affordable lifestyle. A lot of people are leaving the cities, and some are upgrading within the cities. We're also seeing a large number of expats come home and also upgrade their digs or for when they want to return home. And obviously we haven't had migration into Australia since the borders have closed, but that's been replaced by a lot of the expats and the very, very strong domestic demand. But I reckon there'll be a second wave coming once the borders open. We'll see more foreign buyers and more expats wanting to buy properties in Australia. And obviously low interest rates, but everyone says, oh, it's just interest rates. Well, it's not. That's one particular factor, but there's a whole bunch of these other factors here that are leading this boom continuing. So where are we at with prices? Well, here's the current median price as of the beginning of September. $1.4 million for a house in Sydney, $1 million in Melbourne, $684,000 in Brisbane, $899,000 in Canberra. So it's amazing. I do these presentations every couple of months, and I'm constantly having to adjust these prices upward. And it's quite remarkable how strong this market has been the last 12 to 18 months. I'll go through some other figures in a minute, but here's a recent report that's put out by QBE Insurance. They're one of the largest mortgage insurers in Australia. And they're predicting capital growth, quite strong capital growth across all the capital cities. So they're predicting next year Sydney will grow 9%, Melbourne 18%, Brisbane 17.8%, etc. And as I said on the chat, I'll have this slide presentation available, so don't feel you've got to take down every detail I'm telling you. We'll email this out to you in a PDF format. But at the bottom, I guess the message here is we're going to see quite significant growth. And if you're sitting on the sidelines thinking, you know, Rich, should I wait to buy? I think I'll just wait and sit out till the market improves and goes down a bit. Well, you're going to be paying anywhere from 10% to up to 20% more, depending on where you want to buy. I mean, these forecasts aren't entirely accurate, but they certainly indicate a very strong trend, which I agree with. We look at the quarterly price rises. This is the stats from CoreLogic. In the last quarter, actually, Sydney went up 6.4%. In the previous quarter, it was 8.2%. So very, very strong rise. You can see here on this chart that Sydney has the peak rate of growth has passed. So we're seeing growth rates come down, but still very strong growth. It doesn't mean prices are going backward, but the rate of price growth is slowing. I think Melbourne will be the one to watch. Melbourne, I predict, will be very, very strong out of the blocks once it comes out of lockdown, and we'll see quite rapid price rises in the next 12 months. If you look at the annual figures, so this is over the past 12 months, here's where it all adds up. So nationwide, we've had an 18% increase in prices. In this capital cities, Canberra 22%, Darwin 22%, Hobart 24%, Adelaide almost 18%, Brisbane 18%, Melbourne 13%, and Sydney 21%. So you can see there, as I said, Melbourne is a bit behind the times, and that's simply because of lockdowns. The way it worked in Melbourne is they weren't even allowed to do open house inspections. They were completely off the books. Whereas in Sydney and Brisbane, when we've had lockdowns, we've been allowed to do one-on-one private inspections, one agent and one person in the house. So our market has been allowed to operate, fortunately. Now in the regions, if you compare regional price growth with the city price growth, you can see all these red lines here, which indicates all the regions. They've outperformed the capital cities. So as we said, that's that trend or flight to lifestyle. So a lot of people have fled to the regions. And for example, Byron Bay has seen median house prices jump 30% in the last 12 months. Places like the Mornington Peninsula, Sunshine Coast, Gold Coast are also performing very, very strongly. If we have a look at auction clearance rates are a leading indicator of the market. And if you look at these figures here, Sydney and Melbourne are the predominant auction markets. But I would have expected to see in spring, which is the September and October months, these auction numbers to be around 1,000 per week. But because of lockdown, severely constrained numbers. But still, the clearance rate percentages are high for Sydney, usually in the low to mid 80%. Melbourne's been a bit more subdued, and Brisbane has been ratcheting up its auction performance as well. And auctions are very, very hotly contested. They've pivoted to online, but they're still working very well as a sale method. Now, if you're wondering why it's hard to buy a property and why there's not much stock, well, here's the reason why. Listing volumes are significantly down on their long-term trends. This is the volume of new listings, and then my next slide is the volume of total listings. So these are new listings, that is listings coming to the market. And this dark blue line here, you can see it's well below where we should be normally from the past couple of years. So new listings coming to market are down. And then on my next slide here, total listings available on the market is down, what do we say, 29.4% the 5-year average. So roughly 30% lower than we should normally have in the market. So this lack of listings and demand going crazy, basic supply and demand economics, what does it dictate? Prices are rising quite rapidly. So we've seen above average levels of buying activity, but and that's predominantly driven by the lockdowns, where a lot of vendors are scared to list their properties or unwilling to list their properties for fear of catching COVID. And also equally because there's not as many properties on the market, they're going, well, where can I buy? So both of those factors have led to reduced numbers, but I expect it to balance out in the coming months as we head toward the end of the year. This may go over some people's heads, but essentially what we're looking at here is a dwelling sales to new listings ratio. What this ratio means that if you've got a ratio of 1, that is, you've got equal buyer demand and seller demand. So every time a property comes on the market, comes on the market, it's sold. That's a 1-to-1 ratio. But we've been trending at around a 1.2 to even 1.5 ratio, which indicates it's a seller's market. So it's just another way to show that the market is very much in the seller's favour. So how fast are properties selling? On this one here, you can see days on market pretty quickly. All these blue charts, bar charts here, show that the number of days it takes to sell a property in all the capital cities has reduced. So in Sydney, it takes 29 days. In Brisbane, 25 days. Canberra, 34 days. In fact, Brisbane's probably about 7 days, to be honest with you, at the moment. It's going nuts. Very, very strong demand. And the same in Melbourne. Anytime a property comes on, it's often sold in 2 to 3 weeks. A lot of the agents are doing 3-week auction campaigns instead of 4-week auction campaigns because they just don't need to delay it any longer than they need to. Okay, so lockdown blues and clues. I feel like it's a bit like Groundhog Day. I don't know about you guys that have been in lockdown for a while, but it feels like the same day all over again. But soon we'll be out in Sydney on the 11th of October. But as I said, it's having a very strong dampening effect on volumes of listings, which has pushed up prices. But the thing we have learnt from past lockdowns is that when we're locked down, we're not spending as much money. And we also have this pent-up frustration. It's like, okay, I'm just going to get out there and get what I want to buy, whether it's another car or another house or a new pair of shoes. We all want to get out there and spend our money. So what we've noticed is the market does respond very positively. And I think you'll see a very active property market once we come out of all of these restrictions that we're currently under. So let's talk about economists, and I'm actually one of them, so I'm pointing the fingers here at myself. I did a double degree in economics when I was younger and worked in government for 10 years. And economists tend to assume things. They assume things away and make lots of mistakes when they do that. But you recall back in sort of March 2020, February, March 2020, I think it was the Commonwealth Bank came out and said, property prices could drop 31%. And there was a lot of fear mongering going on. So what happened in sort of March, April, May of last year is the market seized up. Virtually very little property was sold, and then it started to really accelerate. So, the reason that these economists get it wrong, as I say, is they just make bad assumptions. So people like Shane Oliver from AMP is typically a bear economist. Same with Martin North from Digital Analytics. The more realistic economists are people like Louis Christopher from SQM Research, who I believe is one of the most accurate forecasters. But for me as an economist and a buyer's agent, I'm at the coalface every day of the property market. I'm seeing how many bidders there are at an auction. I'm seeing how many people are turning up to open inspections. I'm getting inside the agents' heads, and I'm also brushing up against other buyers. So I get to see exactly where the trends are starting to move and what direction they're heading in. Here's a couple of other forward economic indicators. This again is the report recently put out by QBE, and they're looking at forward indicators in 2024. So in 3 years' time, they estimate the cash rate will be only 0.75. So it's not too high. I mean, it's 0.1 now. So that's effectively three or 2.5 interest rate rises. They're predicting that employment growth will be down. Unemployment rate will be down to 4.5%. CPI will be smack bang in the middle of where Reserve Bank wants it at 2.6%. And our population is going to be a bit more subdued. It's not going to grow as fast as we first thought. And housing affordability, obviously, is still going to become problematic as prices continue to rise. So let's talk some practical stuff. That's enough of the theory. How do you buy in a hot market? What do you do here? Well, you can't give up. A couple of things you've got to do. Number one, the mistakes that we often see is buyers often have a really poor buyer's brief. There's a real lack of clarity about what their objectives or their goals are with buying property. Another mistake they make is waiting too long. They're thinking, I'm going to wait for the market to drop. And meanwhile, the market's going up $10,000 a week. Or they don't do enough research. I see buyers think, I'll jump onto real estate or domain, do a little bit of research. That's my research. Well, you've got to do a lot more than that. The other mistake that I used to make, being an economist, I used to analyze things to 4 decimal points, and I'd get paralyzed by my analysis, and I'd want everything to be just perfect before I pull the trigger. I'm sure, Martin, you see buyers like this out there, people that want to know every single interest rate of every single bank before they decide to press the trigger on a pre-approval. Well, it's not about the interest rate, it's about the overall buying capacity of what you've got. And the last mistake is emotional buying as well. Some people just buy on emotion, which again is a danger. So a couple of buying tips for you. Number one, make sure you use Martin and his team to get your finance approved. There's no point going property shopping unless you've got your pre-approval and your deposit ready and available in cash, not tied up in a share fund or a deposit that you can't get out of an account, but have it ready to go. Next, you've got to create multiple buying opportunities. And what I mean by this, don't just have your heart set on one property. When I'm negotiating for a client, I like to have 2 or 3 properties in reserve. So if the first one falls over, which often happens in this market, I can quickly move to a property 2 or 3. And I might miss out on those, but I need to have multiple buying opportunities. I can't just be looking at one property. You also need to access off-market properties. And what I mean by that, properties you won't find on the internet. How do you find them? Well, simply through relationships. So relationships with agents, relationships with owners, and other people that know other people. So I'll talk a bit about how we do that later. Next step is, or tip is, carefully evaluate what you should pay. You can't look back at 6-month prices. You've got to look back only the last 30 to 60 days maximum. Now, valuers will look back 3 months, but 3-month prices ago, in my view, are irrelevant. It's really in the last 30 days that you've got to look at the most relevant sold properties and see what they're trading for. Because what's happened is when property down the road in Smith Street sells, everyone's expectations are reset to what that property sold for. Next, you've got to exchange really quickly, and also you've got to watch what I call buyer fatigue. Be really careful about just getting frustrated and snowed under with your buying process. So just like Martin had in his slide presentation, we have a process that we take our clients to, and even if you do this on your own, you have to do these steps to buy well. So first thing is to define your strategy or your buyer's brief. So that means deciding what your goal is, if it's an investment or a home. What do you want with that investment? Is it capital growth? Is it a yield play, or is it a combination of both? And then deciding what location and what property type will suit your strategy. Then it's about researching the locations that will deliver that outcome and drilling down into current median prices, future projections, vacancy rates, owner-occupier versus rental percentages, etc. Third step is shortlisting and searching for that property. Come up with a shortlist. Then you've got to select the best one, evaluate it, and then do your due diligence on it, pest and building reports and other searches, and then you negotiate the lowest price you can. And then our last step in the process is coordinating the settlement inspection and also recommending a local property manager as well. So we have a property management team within Propertybuyer, so we can also help with the management of the property. So a couple of key things about using a buyer's agent. As I said, we help to create a well-defined strategy. We get access to off-market properties. Now, how do we do that? Well, we have a very, very large agent database. So when a client comes on board, we will send that buyer's brief to our entire database in that localized area. And because we've got long-term relationships with those agents, they will send us opportunities that are either pre-market, that is about to come to the market, or are completely off the market. So the owners may not want people traipsing through their home. It might be someone who's a celebrity or politician, doesn't want their property to be looked at, or it just might be someone that doesn't want to pay marketing costs. So that's one way we get off markets. The other way is through our website. We have a properties wanted section, and we also do quite a lot of work on social media to attract vendors to sell their properties off market to our buyers agents. Third benefit here is having someone on your side being a professional negotiator and knowing when to move forward and when to pull out of a negotiation. And our buyers agents in my team, I've got 19 in my team, they all have specialist localized knowledge, and that's really important. Having someone on the ground that can give you the real insights into the streets and the localities that are really going to work for a long-term good purchase. And basically help you crunch the numbers and, as I said, buy with confidence. So what does it cost and what's the investment to use a buyer's agent? We work generally on a fixed fee basis. So each of our fees are fixed, and it ranges between 1.5% to 2%. So there's a sliding scale. If you're interested, I can email you our proposal after the presentation today. But as I said, you'll have someone working purely on your side all the way through to the exchange and settlement process. And our fees are also tax deductible. It's considered an acquisition cost, so it's 100% tax deductible against future capital gains. Let's finish the last part of my presentation before we move to Q&A, just with a couple of case studies. So I'll give you a little quick rundown on some of the recent purchases we've done. So this is one in Melbourne that Amanda Jones, our buyer's agent down there, bought, and she got a cracking property here, a really nice 4-bed, 2-bath, 2-car home, off market, again, through her relationship with a local agent. And this was for a home buyer that was looking for a quality home. Amazingly, she got it below the appraisal. So it was really about 2 months ago she got this, and it was just perfect timing before the markets really started to kick along. Brisbane's an area that we're putting a lot of our investors into at the moment. It's got a lot of upside. The Olympics are coming in 2032 and the yields are very strong. Typically, we're getting yields on houses of around 5% up there. So this is a classic example, 550K budget, 4-bed, 2-bath, 2-car. Agent was guiding 550 on this one, but we managed to get it for 525 and it rents for 520 per week. Another one we bought in Brisbane, this was actually an ex-display home that was about 2 or 3 years old, and it had a higher yield because we managed to convince the tenant to stay, the display group to stay for a bit longer, so it bumped it up to about a 6% yield. So we got this for $690,000, rents for $800 a week. So again, really strong return. One we just bought, again, for a localised client. We just bought a unit in Surrey Hills. This is a beautiful apartment block. It used to be where the golf house was, just near Central Station. The amazing thing is that this owner bought it about 3 years ago off the plan, and the owner had paid 1.75 for it. And we managed to buy it virtually at exactly the same price 3 years later. So city fringe units have suffered a bit because of the student decline. I think it's a bit of an opportunity for people wanting to get apartments sort of in that city fringe or close to the unis, but that market will come back once the borders reopen over the next 18 months. Yeah, but we picked this one up. We got it just over the 175 mark, exchanged it in 14 days from the time they signed up with us to the time they purchased the property. Actually, Martin, you'd recognise this one. This is one of your clients that we recently bought for. You just did the loan for it. A lovely client based in Hong Kong. Originally, they had a budget a lot higher. They were looking even around 5 million to buy something they could just move into, and it was all beautifully done. But then they said, look, if we can find something we can buy and then renovate or knock down, rebuild later, we're happy. And we got a cracking property in the inner west of Sydney. So the agent was guiding, 2.2 to 2.42, which they typically underquote. And we managed to snare this pre-auction for 2.33. So amazingly, we actually got it within the agent's guide. Normally, properties are going for anywhere from 5 to 10% above the top end of the guide, but we're able to get this within the guide and buy it and beat other buyers before it went to auction. So quite a remarkable result for that client. Another one we bought in Newcastle, really nice townhouse. We bought for 800K. Again, we appraised it at 825, got it for 795. Yields in Newcastle, you typically get around sort of 4 to maybe 4.5%. The yields are coming down because the prices keep rising, but we think the Newcastle market's got a lot of legs as well going forward. Northern Beaches. Oh, this is a great, Mike and Beck. Yeah, this was a house I found off market just in my local area on the Northern Beaches. These guys had sold their property in Normanhurst and were really worried about finding something. And we went on quite a journey. They had quite an emotional roller coaster of a journey buying their home. They kept thinking that they couldn't afford anything. They had a budget of 2.15 and that was their absolute max. But they really, really wanted to buy the Northern Beaches, which is at that price today, it's actually almost not impossible, but really difficult. Anyway, I found a property through our social media work. I found an owner that was willing to sell off market. Now, this owner had 3 or 4 agents through their property to give them appraisals and told them it's worth 2.2. So I said to the owner, look, my clients have a max of 215. You're going to be spending 50 grand on marketing fees and having people come through your home. Are you happy to do a deal? And amazingly, she said, yes, let's do it. So we got a 12-week settlement for both parties, both really happy. And these guys have moved in and are just over the moon. Today, by the way, that property would have gone up. Bought that about 12 to 14 weeks ago. That same property today would be worth about 2.45. And just the last couple, we do a strategy, particularly in Western Sydney. One we've done very successfully is to buy a house and then add a granny flat or find a house with an existing granny flat. The Western Sydney Airport, Badgerys Creek, is going to produce a lot of spin-off benefits for all the surrounding areas around Penrith, St Mary's, etc. We're buying houses up there, or blocks of land, for about 750 to 850. And again, this one has a granny flat. You can't see it in the photo, but a granny flat at the back, and the total yield's around 4.7%. This was just to show you one luxury property that I bought recently for a client, Northern Beaches. Absolutely stunning home, everything that opens and shuts, but the level of finish on this home was just absolutely remarkable. I haven't seen anything quite like it for some time. It had a beautiful outdoor area, you can see there, had really big highlight windows, and looking back the other way, you can see the ocean through the bush, but just a stunning home. Now, I bought that pre-auction. Again, there were 3 or 4 other bidders all nipping at my heels trying to get it, but we got it, again, just under our appraisal mark. And second last slide, we also buy quite a bit in the Sutherland Shire. And this is where Stuart Fraser in our team is a gun at negotiating. He managed to find what we call an out-of-area agent. So someone who didn't really know the local area. We jumped on it. And you love this, Martin. We actually got a valuation back from the bank at 1.65, but we only paid 1.5. So it was 150 higher than purchase price. Now that never happens, right? It's 1 in 1,000 that happens like that. But we managed to nail one. So again, to show Stu's negotiation skill there was amazing. So I think that's it for case studies. So as I said, if you wanted to get in touch with me, my details are there. I'm going to go to the next slide and just leave this next one up, which is our contact details. And I'll finish, actually, how do I get the...
And we can just leave it like this.
I'll just try to find my... I can't read the questions though.
I'll read them to you.
You can read the questions, Mark. I'll leave that slide up.
So I think the $1 million question, Rich, is why not wait till the boom is over? I think you touched on this briefly before, and a lot of people think they should just wait it out. Why should they not do that?
Well, I guess, okay, let's take a case in point. Let's say you're going to buy a $2 million property and you want to wait it out. So I predict that the market, I'm going to talk about Sydney, for example. I think the Sydney market is going to grow another 10 to 15%. So if it grows, just say conservatively 10%, that $2 million property will be worth 2.2 million in September 2022. I don't think it's going to go down. There's no factors that are indicating to me that the market will drop dramatically. Yes, APRA might crimp lending, but there's not another financial crisis or anything looming on the horizon. I mean, there's going to be some geopolitical factors. Even if the market does correct, we've seen in Sydney, it tends to correct a couple of percent. Like during the COVID period at the beginning of last year, it only corrected about 5%. So if you wait, that's fine. You just got to pay more. You know, if you're going to be waiting in Melbourne, you'll be paying potentially 20% more. So I've had to reset my own expectations on pricing as well, even in my local area, because the depth of buyer demand is incredible. You know, when there's only 5 properties on the market and there's 25 contracts out on the one property, there's very little for people to choose from. They're just going to compete over each other. And you've got to realize, okay, when do you pull out and when do you go forward? So that's the skill that we can bring to the table. So cut to the chase, I don't see any factors leading to a dramatic slowdown, and definitely not a correction in the market in the next 18 months.
Yeah, I see. Yeah. What about regional areas? So you touched upon Sydney, but a lot of these overseas buyers that are on the call today, they're doing this mainly for investment purposes. So they're looking at high rental yield regional properties. What are your thoughts on the regional areas?
Yeah, look, I think the regional areas are going to do okay. I think longer term, though, the tide has gone out from the city and gone to the regions, but I think the tide will come back to the city. I think for me, if I'm a conservative long-term investor, I want to be buying a property that's got 3 things: strong population growth, multiple employment opportunities, and lots of new infrastructure development. So sure, I could go and buy in Orange or Dubbo or Longreach or wherever. But for me, I prefer to buy I'd buy in Newcastle, I'd buy in Wollongong, or I'd buy on the Gold Coast, but I wouldn't be buying in, I guess, the much smaller towns. You know, I wouldn't be buying in Dorrigo or Dapto or places, you know what I mean? Like, for me, it's about where's going to be the critical infrastructure and the highest long-term demand. I'm not saying you don't buy there, but if you want to maximize the capital growth and maximize the long-term value uplift, I'd be buying toward the capital cities as well.
Okay, so I got a question for mortgage side of things. So can retirees get a loan? We do have some lenders that will lend against existing properties. So if you have an existing property that is spinning off rental income and cash flows, you can actually collateralize against that to get a mortgage. And then this next question following on with that is, will interest rates be more expensive if you use a mortgage broker? Well, the answer is no. The rates will actually be the same, if not better, because we can actually negotiate on the variable component of things. So that's true for the mortgage side. So maybe another one for Rich. What is your view on NDIS properties?
Yeah, great. I've actually, funny, good question. Just been looking into this myself for quite some time. NDIS is a great scheme to help people with disabilities, the National Disability Investment Scheme. The government's supporting it. Now, you have to be really careful. There's plenty of what I call property spruikers out there promising you guaranteed returns. But what's unknown is how many of these properties are being built. I mean, I can reveal that I've been contacted to find these kind of properties for big financial institutions. So there's institutional investors that are getting into this and buying this in a big way. Now, if they're going to be competing against mum and dad investors, they're potentially going to be, buying up the bulk of that supply. Typically, you've got to rent out the rooms. They might get $30,000 or $40,000 a room, and you might think, oh, great, I'll get a 5-bedroom house and get $200K a year. The problem is, if suddenly there's a cheaper one down the road, your tenant moves out. It's a bit like a commercial vacancy. You could be without a tenant for quite some time. So all I'd say to you is it can be a good idea in the right location, but it is very, very location specific, and you need to do lots and lots of work. So I would treat it very much like a commercial play. For me, if I'm an average investor, I'd get 2 or 3 standard resi properties behind me before I went down the route of getting an NDIS property.
Question from Scantha. So are foreigners only allowed to buy new properties? Yeah. So there's rules where foreigners are not allowed to buy secondhand. They can only buy off the plan or land and build. So you can actually build your own properties. One common question that we have is, if I'm an Australian citizen and my partner's a foreigner or not an Australian citizen, can we get borrowing using both of our incomes? Well, again, it's one of those things where if you went to the right bank, they will actually consider foreigner income. So come speak to us and we'll make sure your partner who's a foreigner can also use their income to help with the stress test. Next question, does Odin Mortgage have anyone based in Singapore? Yes, we do. We can definitely help out with that. And then a few more questions for Rich here. What's your view on the Gold Coast? So, and I guess while you're at it, you may as well touch on some of the other cities as well. So people here are asking about Melbourne and Perth. Sure. Maybe you can just rattle off a few of the cities.
Yeah, sure. Well, we'll start with the Gold Coast. Really love the Gold Coast. Beautiful environment, great beaches, good lifestyle. I'd just be very careful about buying apartments on the Gold Coast. There's certain pockets of the Gold Coast that are either saturated or have the potential to become saturated. I think there's some really good opportunities to buy well on the Gold Coast. Again, it just comes down to the little micro markets on where you're buying there. So, but I think long term, yeah, good area. What I tend to find though is that the incomes of people on the Gold Coast are less than that in Brisbane. And typically I like to buy in areas where there's much higher income or disposable income, because people who've got higher income can afford to buy higher properties. They're more aspirational buyers. So for me, if I'm an investor, I want to buy in areas where there's going to be the highest demand for my property long term. What was the other city? Perth. Yeah, look, Perth's, again, great city, but it is heavily tied to the resources sector. Now, the resources and the commodities market goes up and down, a bit like a yo-yo. Iron ore price is high one year and then it's hit the bottom the next year. We've just seen that coal and LNG gas prices are going to go crazy because China's got a shortage of electricity and desperately needs that sort of thing. So we might see the Perth market really climb. But I think, again, have a diverse approach to building your portfolio. Don't just put all your eggs into Perth. Spread your eggs around different cities. What other cities were mentioned, Martin?
Melbourne. A lot of people asking about Perth and Western Australia, but also Melbourne and Tasmania.
Yeah, Melbourne's great. Look, Melbourne, as I said at the beginning of my presentation, I think Melbourne has got a lot of upside going forward. I see Sydney's ahead of Melbourne in terms of the property curve. If you look at the property clock, I would say Melbourne's probably about 8 or 9 o'clock. It's very much an absolutely rising market. Amanda is saying that the demand on the ground is just crazy. There's just so many buyers there trying to get into the Melbourne market. It also tends to attract a slightly higher percentage of international migrants, even more so than Sydney. So I think Melbourne's population will probably grow at a slightly higher rate than Sydney going forward. So I'm very, very supportive of buying in Melbourne. Adelaide, it tends to fly under the radar. It tends to have a slower population growth. Not to say you can't buy there, but again, if you want to optimize where to buy, I'd be buying in other cities before I'd be buying in Adelaide. And again, Hobart, it's already had a massive run, but the only issue I've got with Hobart is, again, jobs and tourism reliance. I mean, beautiful, beautiful state. So again, just got to be very picky about where you buy in the Tasmanian market.
Yeah. Here's a good one for you, Rich. From Jennifer. As an experienced buyer's agent, can you guarantee a percentage discount on the purchase price of a property?
Great question.
Context, yeah, 800K property in Melbourne. Is your buyer's fee refundable if a property cannot be found?
No. So first part of the question, can we guarantee a discount? No, we can't. We don't pretend to be magicians. So you can't come to me and say, hey, Rich, I found a property that's listed at 1.2 and then I'll pay you a fee if you get it for $1 million. It just doesn't work that way. That's not how we operate. We will get it for the lowest possible price, but we have to beat other buyers. So what we give our clients is lots and lots of information and research around the price and where the value is. We can't guarantee a discount. If you're trying to buy a property at a discount, you're in the wrong year, right? You can't buy properties at a discount in this market. We can get them at, I guess, a lower price to what we consider long-term value or appraised value today. But asking prices are typically underquoted. So it's all about looking at where the value is in that property and getting the right property that fits the client's brief. In terms of our engagement fee, we charge between a $3,000 to $5,000 engagement fee, and we have a 6-month agreement. And 99% of our clients buy within the first 1 to 3 months. It's very, very rare that we go beyond that. In terms of refunding the engagement fee, we have a non-refundable fee unless there's no service. If we haven't delivered service, sure, we'll give the money back, but it's non-refundable because we soon burn that up with the amount of time we spend searching on the ground and investing in the process.
Great. So I got a question from Greg. If you want to double the size of the loan, doesn't that impact the negative gearing? Well, actually, if you cash out equity and take out another loan, depending on the purpose of the loan, it actually does have tax advantages. So if you cash out to buy another investment property, it will actually be treated as an investment loan. Okay. Then next question for Rich is, which would you rather, a Sydney house plus granny flat or a Brisbane residential 3-bed?
Again, it's a very hard question to answer, but let me answer it this way. First thing I'll be asking that person is, where else do you own properties and what are your goals? So I can't just give a blanket answer and say, bang. Again, if that person is chasing higher yield, I'd say go for the Brisbane property. If they're chasing slightly higher capital growth, I'd say go for the Sydney option. I mean, it also depends, like if they've got 3 or 4 properties in Sydney, they'll probably have a land tax problem and it's time to go to a different state to get a new threshold in a different area. So as I said, Martin, it's not a one size fits all. I've got to look at the context of what the client's goals is, what their portfolio is before we can answer that question.
Yep. And could you go to auctions on behalf of buyers that are overseas?
Correct. Absolutely. We do it all the time. Absolutely.
Yeah. And this question from Drew, if we have a contract with you, do we have to buy with you, or can we also just go straight to the local agency?
So yeah, it's a good question. We have what's called exclusive buyer's agent agreement. So the answer is you either work with us or you work on your own. We don't do a hybrid. We don't, if someone wants to work with our services, it's a collaboration, it's a partnership. We're not trying to we don't want our client competing against us going to the local agents, because we get all the intel as best we can from those agents. So it's either an exclusive agreement or they do it on their own. Does that make sense?
Okay. So one from Franco. So is the interest expense tax deductible against rental income for remortgage or refinancing fully paid off investment property. So again, I want to caveat that I'm not a tax agent, so I can refer you to a professional, but my understanding is that if you refinance and take out equity and remortgage, depending on the purpose of the loan, it is tax deductible. So if you take out this loan to do another investment property, that is tax deductible. If you take it out to go on a holiday, that is not tax deductible. All right, question for you, Rich. Do you see underquoting as an issue in the markets you are buying in? And maybe you can explain to some of the first-time home buyers, why would someone underquote, and what is the strategy or what's the thinking behind all of this?
Yeah, great question. I love this one. Underquoting is still rampant, unfortunately. They did put in laws to stamp out underquoting, but there's still plenty of agents. In fact, there's an agent 50 meters from my office that still does it and really annoys me, really gets under my goat. I get so frustrated because, you know, an agent will quote something at $2 million and it's going to sell for 2.7, right? And that's like $700,000 under what it should be quoted. So the reason agents do it is they're trying to create competition. They're trying to attract bees. I call it bees around the honeypot. They're trying to attract as many people thinking, oh, I've got a chance. And they somehow convince the owner that this is a good strategy. Now, if fair trading get wind of this, or it can be proven that they haven't correctly priced the property, then they can be fined. When a selling agent goes to list a property for sale, they have to give the owner 3 or 4 relevant and recent comparable sales upon which to base their advice. And they put that in the agency agreement. Now, there might be a time lag between when they sign the client up and when they go to market, and they might try to justify the price guide. Hey, we signed them up 3 months ago, right? And the market's moved, 5% since then. But it just wastes my time. It wastes buyers' time that spend money on pest and build reports. It's still a problem today.
Yeah. One for me. So Glenn asked, typically expats are required to have a higher deposit of 40%, which means 60% borrowing or 60% LVR. So 5 years ago, it was actually very easy to get 80% lending. Now it is actually quite harder, but actually it can still be done. So a handful of banks will lend 80%, but the majority will lend 70%. So Glenn, you could potentially only need 20 or 30%. But come and speak to us, depending on your situation, maybe you could only put a down deposit of 20% down and you could still purchase something. A question from James Richards for Rich. Do you charge on settlement?
So we charge our engagement fee upfront, and then our final fee is on unconditional exchange. So once the property is unconditionally exchanged, that both parties are locked in, that's when we charge our fee.
Yeah. So there's a lot of talk in the market saying one of the main drivers for property appreciation is net migration, right? Net overseas migration into Australia. And the question that has baffled a lot of people is, given the borders are all closed, foreigners cannot invest, expats cannot invest, where is this demand coming from?
Yep. So go back to my I think second or third slide. I had 16 factors there. And the reasons are expats are a huge factor, very big factor in this market. They've kind of replaced a lot of the migrants that were coming into Australia. So expats is one factor that filled the void. The other factor is COVID lifestyle trends. As I said, people wanting to work from home, needing an office. With people wanting to upgrade their lifestyle. We've also seen, as you see in one of the slides there, a significant contraction in supply. So you've had demand increase 30% for a whole bunch of reasons, and then supply contract 30%. So naturally, you've seen the market respond to very rapid price increases.
Yeah. And I guess another question is, do you expect any corrections in 2011 or 2021 or 2022?
No, I don't. As I said before, I don't expect any contractions. In fact, if you look at Heron Todd's White property clock, they're one of the best valuers in Australia. I've never seen their prediction where virtually all the capital cities are between 9 o'clock and 12 o'clock. That is a rising market. So, and they're Australia's leading valuers. So they're indicating that virtually everywhere around Australia is on the rise. So we're very much expecting, all things to move forward. We definitely don't expect a contraction.
Yeah. Okay. So one question from Franco Trong. Can Aussie citizens living overseas apply for a mortgage and get a offset account while they're overseas? Answer is yes. Expats overseas are treated the same, relatively the same as people that are living in Australia. Question for Rich. Are settlement terms disadvantaging for foreign buyers? For example, I've been told I need to account for a minimum of 60 days to settle.
At the moment, they don't, because a lot of the vendors want longer settlement terms. So normally in New South Wales, it's a standard 42-day settlement period. If you need 60, it hasn't been a drama generally for our negotiation tactics. In fact, some vendors want longer than that.
Yep. Another question from Jua. What is the criteria for you to recommend to buy if there are 10 properties available in the suburb that they want to buy? Do you go out and physically check each of these properties?
Yeah, so we will go, when someone engages us and we look to build a shortlist, we do a full physical inspection of the property. I mean, we want to know, is it next to is it next to a petrol station, right? Is it overshadowed by, a big electricity stanchion? Is it on a busy road? Or what are the factors? So we will go and inspect the property thoroughly, and then we'll come back and do an analysis of the best one to buy.
Yeah. I think one city we missed before was Canberra, ACT.
Yep, Canberra's gone ballistic. I mean, it's obviously the capital of public servants, so a lot of government money swashing around there. That market's been exceedingly strong, and I think it will continue to go very strongly in the next decade.
So we're just about out of questions. So if you still have any questions, feel free to put them in, and then we'll try to cover them off as well. So one more question from Francis Chong. Can we use equity from Hong Kong or Singaporean properties and to use it as a down payment to buy the property? So you can. So if you go to your local bank in Hong Kong and Singapore, we've had clients manage to cash out locally in Hong Kong and Singapore and use that as the down payment to buy property in Australia. All right. Will a link of this recording be sent? Yep. So I think Rich and his team will be sending across the recordings, and then everyone can see the slides as well. Question for Rich. Would you recommend apartments in CBD Melbourne?
Yeah, good question. There's actually, depends where, depends which building. I was talking with my principal buyer's agent, Amanda, about opportunities to buy apartments the other day. And she talked about, I can't remember the name of the precinct, but there's a couple of little precincts, either the city fringe or in the city, that are actually quite undervalued at the moment, because there was a time where with Docklands and all the developers pouring in, there was quite a bit of overhang or oversupply for a period of time in Melbourne. But now that the student population's been decimated, as I said, also in Sydney, I think there's a little window of opportunity to buy a good located, good quality apartment quite well at the moment in the CBD areas.
Yeah. One more question. Are positive and neutral cash flow properties still prevalent in Australia? Have you been able to find these recently?
Yeah, well, with interest rates at 2%, it's quite easy to find positive cash flow properties at the moment. So you saw with some of my examples, the majority of those were cash flow positive. So absolutely, we very much find them all every day of the week.
Yeah. So Jojo says that your data points to apartments appreciating more than houses. What are your thoughts of that?
No, I tend to find that our houses tend to appreciate longer term. Houses tend to appreciate at a better rate than apartments. And it's simply because of land content and land value. So I find that land will appreciate with a house on it faster than an apartment will.
Yeah, question from Glenn. Can you use equity in New Zealand property to purchase property in Australia? Yes, you can. Again, it's subject to LVRs of the different properties. So Australia and New Zealand are linked. So any loans that you have in New Zealand will come up when you apply for mortgages in Australia as well. This question is from Michael. With a budget of under 500,000, where would you purchase for maximum growth living in New South Wales?
Good question. Well, again, that's sort of a strategy question. So I'd rather look, there are areas like the Hunter Valley that I'd be suggesting you could look at. But again, we do a full strategy chat with our clients once they're engaged to identify the particular suburbs and regions. But yeah, west of Newcastle will be one area that I'd be considering.
Okay, great. So I think that wraps up largely all the questions. Again, if you have any more questions, feel free to email me and Rich directly. For the questions that I haven't answered, it's probably because they're a bit more technical and it's not directly applicable to everyone. So feel free to email me and Rich directly, and we'll get back to you on the questions. As mentioned before, these slides will be shared and the webinar will also be shared. So feel free to flick it on to your friends and family. All right. Thank you for your time, Rich.
We might wrap it up there. Thank you everyone for watching, and we really appreciate your time, and we'll send around the recording on the slides. But thanks again, Martin. Really appreciate it. All the best. Thank you.
Thanks everyone. Bye-bye.
Bye.